Hi, welcome to Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest high energy updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic. Bringing you updates every day at 9 a.m., noon, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Well, ladies and gentlemen, something unusual is happening behind the scenes of global finance. The biggest financial institutions in the world are quietly spending billions of dollars, not on cryptocurrencies themselves, but on the infrastructure underneath them. And here's the part most people are missing. These deals are getting bigger and more expensive every single time. So the real question isn't, why are they buying? The real question is, what do they see coming that the public doesn't? As always, ladies and gentlemen, I just want to thank everyone that takes the time to like, subscribe, comment, and share. These simple things really do help out the channel and helps us grow very much. And let's dissect everything right now. To understand what's happening right now, we need to zoom out, because this isn't just about crypto. It's not even just about XRP. This is about a fundamental shift in how value moves across the world. There was a time when sending money across borders took days, multiple banks, high fees, delays. Now imagine a system where value moves as fast as information. That's the transformation quietly being built. We've seen this before, ladies and gentlemen. In the early days of the internet, most people didn't pay attention. It seemed slow, niche, even unnecessary. But behind the scenes, companies were building the infrastructure, servers, protocols, networks. They weren't building for what the internet was. They were building for what it would become. But here's where things get interesting. We may be watching the same pattern unfold again, except this time it's happening with money itself. Recently, a major global payments company made a move, spending nearly $2 billion to acquire a company focused on digital payments and stablecoin infrastructure. On the surface, that might not sound unusual, but when you look deeper, this wasn't an isolated event. There have been multiple attempts across the industry to acquire similar companies. Some deals didn't even go through. Others kept increasing in value, which tells us something very important. The infrastructure is in high demand. The value question. Here's what surprised a lot of people. The company acquired wasn't generating massive revenue compared to traditional financial giants. So naturally, people asked, why did they pay that much? And the answer may be, they're not valuing the company based on what it is today, but based on what it connects to tomorrow. I want to talk about the hidden layer. These companies act as a bridge. They connect traditional banking systems, stablecoins, blockchain networks, and some analysts note that parts of the infrastructure may interact with networks like XRP. To be clear, there are different interpretations of these connections, but what is undeniable is institutions are positioning around faster settlement technology. Now, this next part surprised many people. The real size of the market. Ladies and gentlemen, when most people think of crypto, they think market cap. But institutions don't just look at market cap. They look at transaction volume, and stablecoins alone have processed tens of trillions of dollars in recent years. Let that sink in. The level of activity isn't speculation. That's real usage. And in some cases, it rivals or even exceeds traditional payment networks. Why this matters to banks, you're asking? Banks don't move quickly. They move when something becomes more efficient, more scalable, more profitable. So when you see billions of dollars being deployed into this space, it may signal something deeper, not hype, but transition. But here's where the real twist comes in. When we talk about infrastructure versus hype, most retail investors focus on price. Institutions focus on infrastructure. Think about the gold rush. The majority chased gold. The consistent winners sold the tools. Right now, we may be entering a similar phase in digital assets, where the real focus isn't just the asset, it's the system that moves it. I want to talk about the flywheel. There's a concept called the flywheel. At first, it's hard to move, slow, resistant. But once it starts turning, momentum builds. Adoption of new technology works the same way. First comes experimentation, then real-world use, then necessity. And once it reaches that final stage, acceleration happens quickly. And this is where things begin to connect. The Internet of Value. Some analysts describe this shift as the Internet of Value, a system where money moves instantly, globally, seamlessly, just like data does today. Now imagine if a fraction of global finance moves onto these systems. What would that mean for the infrastructure supporting it? I want to talk about institutional signals. We're starting to see early signals. Large asset managers creating frameworks for digital assets, payment companies integrating blockchain rails, governments exploring regulatory clarity. This isn't random. It suggests alignment, or at least a shared direction. But here's the part most people still aren't seeing: the perception gap. There's a gap right now between what retail investors feel and what institutions are doing. Retail sentiment often swings with price, fear, uncertainty, short-term thinking. Meanwhile, institutions are building, acquiring, positioning. Historically, these two perspectives don't stay disconnected forever, ladies and gentlemen. This is so big, you got to think about what I just said. It's massive. Rewind that if you have to. I want to talk about the timing. Major financial shifts don't happen overnight. They happen gradually, then suddenly. By the time it becomes obvious, most of the positioning has already taken place. So you're asking, what could come next? Looking ahead, there are possibilities. More acquisitions, higher valuations, greater integrations to global finance. Not guarantees, but trends worth watching. Let me ask you something, okay? If the world's largest financial institutions are investing billions into this infrastructure, do you think that they're early or preparing for something much bigger? Drop your thoughts in the comments below. I want to talk about the XRP connection. Now, bringing this back to XRP, the key idea isn't hype, it's utility. If a network is designed for cross-border settlement, liquidity movement, speed and efficiency, then its relevance comes from how it's used, not just how it's traded. And if infrastructure continues building around these systems, that's something investors are watching closely. So here's what we know. Institutions are investing heavily in infrastructure. The market behind it is massive. Adoption appears to be growing, and the broader public is only beginning to notice. This may not be about a single deal or company, but a larger shift in how financial systems operate. So I'll leave you with this. If the foundation of global finance is being rebuilt quietly and the cost of entry keeps rising, at what point does the rest of the world finally catch up? Drop your thoughts in the comments below. Well, ladies and gentlemen, happy Friday. Sorry that this video is coming so late. Just got home and I wanted to make sure I got some content out for you guys today. What a Friday in the markets, right? Lots happening in the market right now that we have to go over. A lot. You know, we're always talking about geopolitical and geoeconomic trends, ladies and gentlemen. Well, you can see it taking center stage and happening right now. And all the things that we've gone over in the previous videos. And if you're new here, please do like and subscribe and understand that when we get to the second part of the video, we have a rant that's totally covering everything that everybody in the Wolfpack has come to love and enjoy. Remember, ladies and gentlemen, we've already set the table with the themes that we're watching. Now it's just time to eat the main course. And always remember this. One good tip from the pits can easily pay for your entire year's subscription. If you want deeper macro research and learn how to take advantage of all what we talk about, please come and join the almost 400 members in our Patreon community. And welcome to all the new members of the Crypto Trading Desk Monthly. So looking at what's happening right now and how markets are settling, the big things that we left you off with in the last video, where was oil going to go? It's so amazing if you watch the previous videos, but before this video, it really tells you where the world is going. Everyone's talking about Carg Island now. We're going to go over this right now, about energy infrastructure getting hit and why prices are spiking. But this is the most important thing I want everyone to understand. Let me be very clear with you. The market right now is completely mispricing reality. You have a historic energy shock unfolding, global supply system under stress, central banks that are not easing but preparing to hike, and yet capital is still blindly chasing AI like nothing else matters. Crazy. This is not normal. This is late cycle behavior. And I'm going to break this down right now using institutional level data. Exactly why this setup is one of the most dangerous and asymmetric environments we've seen in years. Again, I want to talk about the oil shock everyone is underpricing. You have to go back to some of our videos to understand. The previous video before this is very important, and the one before that about LNG. Let's start with the foundation, energy. According to Goldman Sachs report, the base case is simple. Oil is going higher for longer. Not maybe, not potentially, structurally higher. Why? Because the global system is now dealing with a supply shock, centered around the Strait of Hormuz, one of the most critical oil arteries in the world. Here's the key data most people are ignoring. Iran plus Persian Gulf countries equals 30% of global crude production. In the past, supply shocks over the last 50 years, productions fell 42% on average over 4 years. You got to let this sink in. This is massive. Again, 42%. This is not a temporary strike. This is a systematic supply disruption. The chessboard is being redone. And Goldman is explicitly saying Brent could exceed its 2008 all-time high. Oil stays above 100 in prolonged disruption scenarios. Now think about what that means, ladies and gentlemen. You got to think about it. This is huge, huge, because oil is not just an asset. Oil is transportation, food supply chains, industrial production, inflation itself. If oil stays elevated, inflation's not going away. Growth slows, margins compress, consumers get squeezed, and yet markets are still behaving like we're in a soft landing. That's delusional. That is completely delusional in our opinion. None of this is financial advice. This is just our opinion, and anyone retains any capacity. It's complete delusion. I want to talk about the second order effect. This is called structural scarcity. Here's where it gets even more interesting. And this is where most retail investors completely miss the plot and do get cut up like sushi, unfortunately. Goldman outlines something critical. After shocks like this, countries increase strategic stockpiling. Why, you're asking? Because trust is broken. If the Strait of Hormuz can be disrupted once, it can be disrupted again. So what happens? Governments hoard reserves. Strategic petroleum reserves increase. Supply available to markets shrink further. This creates a feedback loop. Less supply, higher prices, more hoarding, even less supply. This is how commodities go into multi-year super cycles. Ladies and gentlemen, what we're seeing now, this is something, again, in my career, I've seen a bunch of this, but this is the biggest one ever. And to not capitalize off of the chaos that's happening right now, as far as I'm concerned, is the worst thing that you can do to yourself right now, because the world is coming apart and being rebuilt at the same time, in our opinion. And I want to go more about this. Risks to oil prices are skewed to the upside, both short-term and into the 2027 year. So if you're still thinking this is a temporary spike, you're already behind. The AI trade, the last mania standing. Let's talk about the elephant in the room, AI, because this is where the market contradiction becomes obvious. Goldman literally says the only thing that the market still wants to buy is AI enablers. Think about that. In the middle of an energy shock, rising inflation risk, central banks turning hawkish again, capital is still flowing into AI. Now, to be fair, the fundamentals are real. Demand is exploding. AI tools are becoming generally usable. Companies like NVIDIA and Micron are confirming it in actual numbers. And here's the key stat. Some memory names are trading at 4 to 5x earnings with 100% EPS growth. That's insane value on the surface. But here's the problem. The market has zero conviction or terminal value. It's so huge. Again, the market has zero conviction on terminal value. So what you're seeing is short-term earnings strength, long-term valuation uncertainty that creates instability. So even if NVIDIA and the king of AI is facing the issue, $5 trillion valuation, eventually compressing to low double-digit forward PE, which tells you something very important. This is very, very important. If I'm going too fast, rewind it or slow down the flow. The upside is no longer driven by hype. It's now constrained by math. This is what happens at the late stage of a thematic trade. This is very important. This is the late stage of a thematic trade. So if you look at where emerging markets, this is where smart money rotates. Emerging markets is hot right now, and this is where the smart money is going. This is so important. Now, here's where institutional capital starts getting tactical. Goldman looked at previous oil shocks, 2011, 2019, 2022, 2025, and the pattern is consistent. Energy exporting regions outperform specifically Latin America, South America, while India and emerging markets Europe lag. Why? Because higher oil equals terms of trade shift. Money flows towards commodity producers, energy exporters, resource-rich economies. And Goldman explicitly says that there are tactically opportunities in Brazil, South Africa, Korea, which we love Brazil and South Africa, and sectors like energy, metals, and mining, semiconductors, GARP plays. This is key because while retail is chasing AI at peak narratives, institutions are quietly rotating into real assets and commodity leverage. So if you look at what central banks, the trap that no one's pricing into, this is really important. Now we get to the most dangerous part of this entire setup. Central banks. The market still believes cuts are coming, but Goldman and a lot of other people on the street, they think opposite. We think opposite as well too. Let's take the ECB. Let's look at the base case. They hold rates, but in an adverse energy scenario, 50 to 75 basis points of hikes. In a severe scenario, 100 to 175 basis points. Let me repeat that. In an energy-driven inflation shock, central banks don't cut. They hike. This is important. People are going to get cut up like sushi because they're not paying attention to what's coming. In the markets, whenever you're in the markets, ladies and gentlemen, it's like driving a car. You have to look what's way in front of you, not what's right in front of you. You got to see what's in the road. Again, not what's behind you, what's coming. Same story with the Bank of England, holding at 3.75%, but signaling willingness to tighten if shocks persist. Translation in English, the reaction function has turned hawkish again. So now you have slowing growth, rising inflation, tight monetary policy. That's not a soft landing, ladies and gentlemen. That's stagflation risk. That's so important. Again, you're going to have to rewind. That's very, very important. So Here's the big mix pricing that we think is coming, in our professional opinion, not advice. So I want to zoom out right here. Here's the big picture. Oil is structurally going higher. Supply shocks historically last years, not months. Governments will hoard, tightening supply further. AI is strong, but increasingly crowded and valuations constrained. Capital is quietly rotating into commodities and emerging markets. Central banks are not your savior. They're boxed in, ladies and gentlemen. This is huge. And yet markets are still priced like inflation is temporary. Growth is stable. Liquidity is coming back. That is the mispricing. That is the opportunity. And that is the risk. Because when reality catches up, it doesn't just adjust slowly. It reprices violently, and people get caught up like sushi. Again, but being the remora, we got that Gucci clarity because we're underneath the apex predator, and we know where the world is going because we're swimming with them. Again, and we will not get cut up like sushi. So if you're serious about navigating the cycle, you really need to stop thinking about retail and start thinking like capital allocators. Because in this environment, scarcity wins, energy wins, real assets win, and everything else is just noise. Ladies and gentlemen, again, there's so much delusions in the market. And, with the family office that we were just visiting with, listening to what they're being told by other banks is quite shocking. But again, the things I always harp on, right? And again, we're going to have an update from on the tips and the pits right here in LNG. Stay with me. We harp on where money flows to the easiest trade. You got to make your weekly, your quarterly, and your monthly numbers. It's easier to trade crude oil right now, Brent, WTI, even Euro contracts in Russia than everything else. Gold, if you've been taking our calls on gold and silver, I salute you. Though that's free from everything like that. I don't, you got to be sitting there with a big smile on your face. But if you look at everything we've talked about in previous videos, we spoke about a lot. People are getting massacred right now. They're not positioned for this. The true whipsaw is coming. And why I told you last video that we sit and wait to see what happens now. And once we saw what was going to happen, we take advantage of it. And what I mean by what happens, this is the most important thing that everyone needs to pay attention to right now. Iran attack wipes out 17% of Qatar's LNG capacity for up to 5 years, according to the Qatar Energy CEO. Iranian attacks have knocked out 17% of Qatar's liquefied natural gas, LNG, export capacity, causing an estimated of $20 billion in lost annual revenue and threatening supplies to Europe, Asia. It's crazy. I mean, again, according to the CEO, 2 of Qatar's 14 LNG trains and one of its 2 gas-to-liquefied facilities, DTL, were damaged in the unprecedented strikes. The repairs will sideline 12.8 million tons per year of LNG for 3 to 5 years. 3 to 5 years. Those tips in the pits that we put out on LNG, my God, they've gone through the roof. Again, I can't believe it, but we give this away for free. If you want to understand, ladies and gentlemen, how we capitalize off this, do come and join us in the Crypto Trading Desk monthly in our Patreon and see 1 tips from the pit pays for your entire year. It's in my opinion right now, the chaos that's being caused, never in my wildest dreams where I thought that Qatar and in that region would get attacked from, I just never, especially during the time of their holy month. I mean, it's unbelievable. But again, what we said in a different video, that when you destroy infrastructure, the price spikes. This isn't some storage shed. Rewind what I just said. This is hardcore infrastructure. Again, a lot of our time right now is going to visit people and family offices and funds that retain us because we've been so dead on the money with everything with our calls telling you what's going on. If you found this channel, please do subscribe and like because you're going to learn a lot. And even if my haters, you're still learning. It doesn't matter. You know what's going to happen before and why. And once the table's set and you got your recce, you got your who, your what, your why. You're not getting cut up like sushi. You're looking at what happens every day, almost like a sporting match. This side goes against this, vice versa. And you're handicapping what's happening and the damage, what it can do, and how much alpha from the plays that you're taking on from our tips in the pits, what it's making. It's raining alpha. It's raining alpha. If for anyone who's been here for the past month, just listen to me right here, you're raining alpha. It's unbelievable. I mean, it's just unbelievable. You can't even, if you look at it, also going back to Qatar Energy, they may have to declare force majeure on long-term contracts up to 5 years. If they declare force majeure on long-term contracts up to 5 years for LNG supplies bound for Italy, Belgium, South Korea, China due to damaged trains, look out. Please return to your seats, ladies and gentlemen. We're about to lose cabin pressure. Those positions are going through the roof. The downtrend, the derivative positions off the positions we said are going through the roof. You'll have no fertilizer, no sulfur, nickel, copper processing. Oh my God, lions and tigers and bears. My God, what's going to happen? It's biblical what's happening right now. I mean, these are long-term contracts. It's unbelievable. They got rid of the short term. Now you're looking at long term. Even ExxonMobil is going to be impacted by this and their byproducts. U.S. oil major ExxonMobil is a partner in the damaged LNG facilities. The Texas-based firm holds a 34% stake in LNG train S4 and 30% stake in train S6. That's crazy. The fallout extends well beyond LNG. Qatar's export of condensate will drop by 24%. That's massive, while liquid petroleum gas, LPG, will fall 13%. Helium output will fall 14%. Naphtha and sulfur will both drop by 6%. This is massive. So if you look at what's happening, the damaged units cost approximately $26 billion to build. So Qatar Energy has declared force majeure on its entire output of LNG after early attacks on Ras Laffan production hub. So for production to restart, you need hostilities to start. You need hostilities to end. For production to restart, you need hostilities to cease. Do you realize what I just said? Do you understand that for the next 3 to 5 years, there's going to be pandemonium? And all this with the Golden Passage trains opening in the U.S. Unbelievable. If you go back to these videos, it's like we might as well be telling the news. That's why with the last video, we left you off what was going to happen with oil. Everybody, it's unbelievable. Crypto, we're going to get into this now. Ladies and gentlemen, again, and I just want to welcome everybody. It's unbelievable. It's unbelievable what's happening. Again, now I'm going to go right now into crypto, XRP, BTC with some updates, but you got to understand something. The world is being rewired, and every day things change that I never thought I could conceive in my lifetime. I never thought that they would take out facilities, but they are. And when we talked about there's more Marines being dispatched now to the area, Carg Island, another island. I mean, you don't even got to watch the news. You can just watch the end of this rant, and you can sit there and take notes and see what it is. But again, if you want to see how we're helping other people take control of their own financial destiny with tips from the pits, do come and join us in the Crypto Desk Monthly. Do join us. Again, one trading tip pays for your entire year subscription. I got a community of over 400 people and growing every day. I want to talk about this. For many BTC proponents, ongoing global developments reflect the type of turbulence they anticipated when first investing in this asset. 43% of BTC supply has remained unmoved for 3 or more years, suggesting continued conviction in its long-term outlook among holders. We have often pointed out that episodes of political or economic geopolitical uncertainty represent opportunities for BTC proponents to highlight the asset safe pitch. We told you that when printed to win it begins, baby. Printed to begin it wins. Going to be massive. Going to be massive. Not financial advice, my own opinion. These episodes have included U.S. government shutdowns, White House and Fed tensions, or calls for Germany to repatriate gold from the U.S. For long-term BTC proponents, these developments represent an opportunity to pitch the asset, but at the same time validate its core thesis, established at the network's inception. Bitcoin's 2009 Genesis block, mined by the asset's presumed creator Satoshi Nakamoto, featured the message. The Times 03 January 2009 Chancellor on the brink of second bailout for banks. The message served as an allusion to the economic turmoil of an era and the alternative monetary system the asset was designed to represent. The view that global developments reflect the type of turbulence that many BTC investors envision when first purchasing the asset can be gleaned from the asset's blockchain. 43% of BTC supply has not moved for 3 or more years. Let that sink in. It's massive. This metric reached an all-time high of 47% in May 2024, and despite the asset having appreciated by as much as 80% at one point during that period, it's massive. It's declined to only 4%. This suggests continued conviction by the BTC by the asset's holders. So if you look at it additionally, 32% of BTC supply has not moved for 4 or more years. It's crazy. This metric has been increasing since October. People are buying for the long term, ladies and gentlemen. They're digging in, and it's nearing record highs. So in parallel, long-time early proponents of the assets are being increasingly joined by individuals and firms with authority within traditional markets. The most notable example of this is BlackRock CEO Larry Fink, who has described gold and BTC as the asset of fear. Asset of fear. According to Fink, you own these instruments if you're frightened of the debasement of your currency. You own it if you have financial insecurity. So, you got to let that sink in, ladies and gentlemen. It's right here, So, in October, Morgan Stanley issued guidelines for crypto allocations and multi-asset portfolios. In an October Global Investment Committee report to investment advisors, analysts at the bank described BTC as a scarce asset akin to digital gold. So the takeaway in English, for many long-time and ardent BTC proponents, ongoing global conditions are viewed as conducive to the asset's adoption, as we noted. Blockchain data suggests long-term holding is widespread among investors. BTC proponents are hopeful that the ongoing conditions of global uncertainty will prompt new investors to explore the asset. This is so huge what's happening, ladies and gentlemen. It's massive. So you got to understand something. The U.S. wants to become the crypto Bitcoin capital of the world. Things are changing right now. As far as we're concerned, things are changing. It's whether or not you would like to capitalize on what's changing. You understand me? And not look at daily candles. Here's some quick crypto headlines, and I'm going to end it with today on a strong note. JP Morgan analysts report that Hyperliquid is attracting non-crypto traders as demand rises for continuous traditional assets trading. Hyperliquid is offering an increasing array of perpetual futures, offering exposure to macro assets outside of traditional business hours. Things are trading, ladies and gentlemen. Coinbase has launched stock perpetual futures for selected U.S. equities and ETFs for eligible non-U.S. users. The contracts provide 24/7 leverage synthetic trading and are settled in USDTC, baby. Ledger has appointed John Andrews as CFO and opened a new office in New York City as part of a multi-million-dollar U.S. expansion. The New York office will also serve as strategic hub for Ledger's institutional business and aims to meet growing demand for a secure digital asset infrastructure. Ledger is planning an IPO, according to reporting. It's massive what's happening. It's just you can't even. It's so crazy what's happening here. Gemini Space Station Inc. reported a roughly 30% workforce reduction since January 2026 and posted a USD 585 million full loss. Mirrored, a prediction market operated by Decrypt's parent, Distan, has completed a seed funding round with participation from MoonPay Ventures, Urus, Virta Ventures, and several individual crypto investors. The funds will support product development, liquidity, and market expansions following Mirrod's Season 3 launch and migration to BNB chain. Again, it's so crazy what you see happening right here, ladies and gentlemen. The world is changing. And always, this is not financial advice. This is my personal opinion. The world's changing right now. We're stuck in a new reality again, right? We have the Clarity Act. We're in the camp that it gets done. I keep saying that. We got major banking news coming up for people that have applied for bank charters. I don't know how much more conviction you need to see how the world is changing and why big players are doing what they're doing. We believe the bill is slowed down, in our professional opinion, so you allow other banks to buy assets in the space that you see happening. There's so much going on right now. This is where you have, being a financial mercenary, we do this every day. We take advantage of what's happening, always. That's why we don't get cut up like sushi. But again, if you want to see how we take advantage of us, do come and join us. There's just too much to be happy right now. But with that being said, this content's for informational and entertainment purposes only, should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions, always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves to never happen again. Or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right into the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. So open your eyes, smash that like button, ring that bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you content, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. Love you all.